Hello guys, welcome to FinBites Virtual Workshop Season 7, sponsored by Train Manza, a millionaire's guide to stock market. Please make sure you check the link in the description. We, FinWiz, are not SEBI-registered financial advisors. All the information provided here for the sake of education and should not be taken as financial advice or investment idea. Investments are subject to market risk. Please research thoroughly and invest only on personal discretion. Today we are going to talk about initial public offering, IPO. Initial public offering is a process through which a private company goes public by issuing shares to the general public. This is a process where a private company, which is owned by the private people or a group of private people, known as investors or promoters, they want to take the company to public. That means even the public, general public, retail investors can have access to the company and can have a ownership or a part of ownership of the company by investing their own money. This is known as going public. As the name suggests, going public means public can have the ownership of the company. This is a type of offering where shares of companies are sold to the general public for the first time. That is why we have the name initial public offering. Initial. That means we are going to public for the first time, offering shares to the public for the first time. This is done by the diluting the shares or the ownership which was initially held by the promoters or private investors. IPOs are often issued by smaller and younger companies seeking capital to expand. But this can also be done by the largely privately owned companies which are looking forward to go public and be traded in the public stock markets. And the process of going public can be divided into three segments. The first segment is preparation or approvals. Second is marketing and estimation of the price range. The third and final would be launch and completion. The first one step in the preparation would be obviously a decision to go public, then the appointment of BRLM and legal counsel, then due diligence, drafting and red herring, filling with the SEBI and stock exchanges. Then coming to marketing and estimation of price range, it would be pre-marketing, then SEBI clearance and RSE filling, then the roadshows, so the public awareness or making the public be aware of that the company is going public so that they can invest in the company. And the final launch or completion would come. It consists of book building, price and allocation, ROC filling of final prosecutes, listing, and fund transfer to issuer. And IPOs have the eligibility criteria such as it should have a net tangible assets of 3 crores in at least 3 preceding years. And a track record of distributable profit of at least 3 out of 5 preceding years. And the company should have a net worth of 1 crore in preceding 3 years. This proposed issue should not exceed 5 times of it per issue. Obviously, like anything, investments will have its own advantages and disadvantages. By IPO, main reason for a company going public and issuing share to the public is the reason to raise capital. Any company to raise capital has two ways. One way is to take a debt, take a loan from the banks or some other means and raise debt. And another way is to sell our ownership to the public or other investors and raise the capital. And this capital can be further used to expand the business or improve their working conditions or expanding the region of where the business operates and everything. These are the main advantages of IPO. But coming to the disadvantages, going public means when the company is public, the company requires to disclose all the financial and business information to the general public. Because if you think like this, you are owner, so you obviously want to know what's going inside the company. Since it's not just a private company now, even you have the ownership and you have a right to know what's going inside. If you don't know what's going inside, how would you be decide to invest in it or not, or what's going inside? So the company now no longer can keep the financial account statements and everything private. It needs to disclose all this to general public retail investors. So this process would require a lot of time, effort, and allotting resources, and this will cost money, resources, and also it requires a strong team of legal and management and financial team. This will again cost money to the company, and also there will be additional costs such as they need to appoint an investment banker which will help them in going public and deciding a correct price range for this. So that's it for today.
Hi guys. So in the last few sessions, we've covered the basics of the stock market, and just before we've been talking about IPOs. Now we're going to talk about market timing, actually buying and selling. This entire concept that you can buy stocks right at the bottom and sell them right at the top is a myth. If you try to time the market, you're probably going to have a very bad time. Now, what is market timing basically? It means that you can predict when the market is going to crash and predict exactly when it's going to start rising and make your buying and selling decisions according to that. I wish all of us had a crystal ball like this which could predict the market's upturns and downturns. There are many of us here who probably, sell a stock and then we see it go even further. We kick ourselves and question us about what we could have done to avoid selling too early. The answer to that is nothing. The idea that you can buy right at the bottom and sell right at the top is a myth, and there's nobody in the world who can do so perfectly. Maybe once or twice for sure, but there is nobody who has been able to pull this off consistently. The opposite of market timing is just buying and holding as the market goes through its cycles. Believe it or not, historical research shows that this strategy has outperformed people who try to time the market regularly. Why is selling right at the top not possible? Well, it's not possible because more often than not, by the time we get a proper sell signal, it is often too late. When the crash comes, it's like a herd of sheep walking right off a cliff, right? Many people believe that they can just stop right there, but it's not possible. Historical performances tell us otherwise. You don't know when you're jumping off the cliff. Market timing also has its costs. One of the biggest costs of market timing is being out of the market when it unexpectedly surges upward, potentially missing some of the best performing months of it. For example, someone could believe that the market is going to fall down and they would sell off the equity and place the money in some either low return conservative investments or just sit completely in cash. While this money is out of stocks, the market could enjoy a very high performing period. A very great example of this would be the stock market crash last year in the month of March because of COVID. In a span of 1 week, stock markets crashed as much as 30 to 40%. Our own Indian index Nifty fell from 12,000 to 10, 9, 8. And once it started reaching this range of 9,000, 8,000, people thought we're going to see Nifty at 5,000 and 6,000 soon. And they started exiting and sitting on a bunch of cash thinking they're going to deploy it when Nifty falls down to those levels. Now, we all know what happened after that. The stock market had one of its greatest rallies of all time, almost doubling in a span of 10 to 11 months. Here we have a small snippet which shows us how bad it can be when you miss out. So this is a 30-year period. A 30-year period, if you've just left your money untouched, it goes on to show that your returns are $17,281. Whereas if out of 30 years you were to just miss 10 top performing months, your return comes down from 17,000 to $7,000. And if you would miss 20 months, from 17,000, your return is further cut down to just $3,000. Out of 30 years, just missing 20 months by trying to time the market could have this much of an opportunity cost. This meme summarizes really well what happened to people who started selling their positions when the market was falling. Then it was already too late. This is another example. This is a snippet from one of India's best performing funds, Marcellus. This portfolio has averaged a return of around 40% ever since its inception. Now, here we see that this blue line represents a 3 month average of its performance, whereas the orange line represents a 1 year average performance. If we notice that the 1 year performance, the portfolio has never given us negative returns, whereas most of the data points, which are the small square blocks, fall within the 20 to 30%, and some of them even coming towards the 40% range. However, if we try to time the market, which is taking the returns over a 3 month period, what we see is that there are so many times where the returns are negative. And the most surprising part is that even by trying to time the market, the most data points, which are these blue blocks, still end up falling within the 20 to 40% range. By trying to time the market, you're basically getting the same returns as you would have gotten if you just bought and held. Another disadvantage of trying to time the market instead of using the buy and hold strategy is that you will build up excessive charges and you end up paying way more tax than you would have if you just, bought and hold till your goals are met. It's also impossible to completely change our mind about a company so quickly. For example, fundamental investors like to understand how a company works. Since 3 to 6 months are too short a time period to understand how a company really works or see its performance, how can we then change our buying or selling decisions in such a short span of time? The best an investor can do, active investors like us who at least try to time the market, is that we can get out when we feel like there is a crazy frenzy in the market. We might end up getting out too early and once again miss some of the gains. This might seem like market timing, but it's not. For example, the markets rallied like crazy from 1991 to 2001, which was the dot-com bubble, but nobody would have seen the crash coming after this. Many great investors such as Warren Buffett, Howard Marks, and Peter Lynch completely stayed out of this rally over a 3 to 4 year period. And then after that, after the crash, the real tech companies which survived it, these were the tech companies in which these people invested. Even though they might have missed out on a crazy run for a short period of time, they had the personal satisfaction of knowing that in the long run, fundamentals always win and they have consistent returns. Does this mean it's completely impossible to time the stock market? No, this does not mean that it is impossible to time the stock market. For people like us who seek to be active investors, it is doable to an extent. Just don't expect to sell right at the top and buy right at the bottom. In bear markets, dollar cost averaging can be a golden strategy. For example, what I mean to say is that we can buy at every point where we think there's some value. If we find a stock attractive at 1000 rupees, is it not even more attractive at 900 rupees? Falling prices should always be a sign to buy, not sell. It is also impossible to know when a crash is going to come. So instead of waiting for the exact top, it is best to get out when you feel like there's too much frenzy in the market. Of course, once again, this strategy applies only to active investors like us who are trying to beat the market. For passive investors, just buy and hold. After a crash is one of the best times to buy companies which we have been targeting as for a very long time. For example, if there was a stock which used to trade at 1400 rupees and after a crash you're getting it at a price of 800 or 900, forget long-term growth. There's a chance that at least the stock will recover to its pre-crash price, giving you good room for returns. Instead of trying to predict when a crash happens, we can try to predict gains after a crash. This is the most effective way of trying to time the market. Of course, for this, we need to invest in companies that can survive the crash. Following a crash, we want to choose well established companies and make sure that we do our due diligence to find out companies that can keep competitors away from carving away their portion of market share. These kind of crashes, instead of being afraid, these crashes can be a great time to buy great companies at cheap valuations, not just for the long term, but even for people who are just looking for like a short term recovery or something like that.